Hello and welcome everyone, and thank you very much for joining us today. I'm Charlotte Taylor and I am the GDC Communications and Impact Manager. You may already know that back in April, the GDC and Acumen co-hosted the very first Last Mile Distribution Investor Forum. And today we're really excited to be sharing the groundbreaking research findings and key takeaways from the forum with you, our members, and with the wider LMD community. So let's get started. So here's the plan of action for today. I will briefly set the scene before handing over to my colleague, Fede Hinrichs, who will present key findings from our latest research on the growth and fundraising journeys of last mile distributors. During Fede's presentation, we'll also hear insights directly from a couple of GDC members, Bidhaa, Sasa and Zonful Energy, who will share more about their fundraising journeys to date. We know that hearing about their experiences will add real texture and colour to this conversation, so thank you so much, Rossio and William, in advance for your contributions. Lucy Klarsfeld-McGrath of the GDC and Hystra will then present the key outcomes from the Investor Forum, including a set of priority activities that the GDC will be taking forwards. And that will be kind of over the next 6 months or so, with the support of Get Invest. So our objectives, as you can see on the screen, are really threefold: to explore this brand new research with you, to share key outcomes and next steps from the Investor Forum with you, and of course, to hear your thoughts and feedback. Commitment, collaboration, and coordination will be key to bridging the access to finance gap, and we welcome your thoughts on how we can achieve this together. So as always, we encourage questions and comments throughout the webinar. Please drop these into the chat box, and the GDC team members on the call today will do their best to answer them as we go. We'll also have space for a Q&A towards the end of the session. Now, before jumping into the meat of today's conversation, we'd like to get a feel for who is in the room. So you should see a poll on your screen now. Please take a few seconds to answer this. We're really keen to get a feel of what type of organisations we have today. That's great. You should be able to click on the answer of your choice by hovering over it. And while answers are coming through, I'd also like to welcome you to add your organisation's name to your name in Zoom. This will help others to kind of navigate the participant list and connect with you. So you should do this by finding your name in the participant list and then selecting rename. Okay. Really interesting. It's so great to see that there's lots of last mile distributors on the call today, hopefully lots of GDC members, and also great to see that there's kind of a good mix of others, which is obviously very handy as making progress on this important topic is definitely going to be a collaborative effort. Okay, so with that insight, let's move on to the next slide, please. So what do we mean by bridging the gap? Well, we all know the stats. Millions of people around the world lack access to products and services that can improve their lives. To meet the Sustainable Development Goals, last mile populations need access to beneficial products and financing to afford them. And as many of you on the line today will already be very well aware, LMDs have a crucial role to play in driving demand for these products and delivering them to the hardest to reach consumers. And as you'll see on the next slide, the GDC's membership alone has reached more than 35 million people to date, with products including solar lights and productive appliances, improved cooking solutions, water filters, agri inputs and equipment, and nutrition and health products. But thousands more such companies are needed to replicate their work. To unlock the full potential of the last mile distribution sector, all types of funding are needed. But even though the importance of last mile distribution is increasingly recognised, capital is still not flowing into the space, and the capital that is flowing is not sufficiently inclusive or tailored to the sector needs for several reasons that we'll hear more about today from our speakers. Next slide. So what do last mile distributors have in common? Well, they're all engaged in distribution and retail of beneficial products to households that are poor and or remote. But LMDs are a diverse group with diverse impacts. They operate across a wide range of geographies. So currently GDC members work across 53 countries. They sell a diverse range of products, with over half selling more than one type of product category. So for example, selling off-grid solar as well as water filters or nutritional products. They sell a diverse rate, they participate in a range of activities across the value chain. So about 69% of GDC members provide consumer financing and 65% offer warranties. And while the majority of LMDs are young and small, with annual sales turnover of less than 100,000 US dollars, there is a good percentage of LMDs, as you can see on the screen, that have actually grown beyond the 1 million in annual revenue mark. So as mentioned earlier, the GDC's 200 plus members have reached more than 35 million people to date, 3/4 of whom live in poverty on less than $3.20 a day. Some distributors focus on scale and deliver specific impacts like electricity access or clean water in large numbers, while others prioritize market development and operate in the hardest markets. And they really leverage community and agent networks to create trust and demand in these areas, often paving the way for more mainstream retail channels. Around 70% of LMDs are locally led, which means that they have at least one founder from the country or region in which they operate. And we believe that local companies like these have potential to bring additional impacts, retaining more value within the local economy, supporting local innovation and building highly localized teams, although this is difficult to quantify. Most distributors are for-profit companies striving for commercial viability, but some operate as not-for-profit and use grants to achieve impact, which isn't possible using a for-profit model because they focus on reaching the ultra-poor or the very hardest to reach customers. And these kinds of entities also play a really key role in terms of, among other things, advocacy and stimulating local entrepreneurship. Next slide. Okay, so that's the scene set, but what was our journey to today's webinar? Why are we here? Well, to date, the GDC's activities around access to finance have been focused on helping our members to connect with funders and get better information about funding opportunities. For instance, in our monthly newsletter and also the LMD funding database on our website, which you may already have seen. We've also generated lots of market intelligence to help funders understand the sector, for instance, in our State of the Sector report and more recently through a series of blogs and webinars. But as we have spoken to more funders, we've realized that there remains a huge disconnect between funders and distributors. So we did about 6 months of consultations with around 30 funders who shared really powerful insights with us and also asked us lots of questions, some of which we hadn't necessarily considered. So to help them understand the sector and the opportunity better, we embarked on an in-depth piece of research and set up a last mile distribution investor forum, really with the objective of enabling these funders to understand the existing barriers, to learn from what is and isn't working, and for us to start developing concrete solutions together. So with that, I'll hand over to Fede Hinrichs from the GDC to share more about our research. So this was first presented at the Investor Forum in April, which, as I mentioned, was co-hosted by the GDC and Acumen and funded by UK Aid. The research itself is supported by both UK Aid and Get Invest, which is a European programme aiming to mobilise investment in decentralised renewable energy, supported by the European Union, Germany, Sweden, the Netherlands and Austria. So a very big thank you to these partners for their support, and over to you, Fede.
Great, thanks, Charlotte, and hello, everyone. So the research I will present is based on in-depth interviews with 21 LMDs. That represents about 10% of the GDC's membership today. We focused on the bigger members, those that have annual sales revenues above the $500,000 mark, who are well placed to share their experience with fundraising, given their longer trajectories. Within this selection, we looked for diversity in terms of geographic scope, the products that they sell, the business models that they use, and included both local and international companies. A couple of things that you may want to retain is that most of the LMDs in our sample are companies that provide consumer financing, and about half of the companies that we interviewed are locally owned and led companies. Because of our focus on the bigger LMDs, we should not see this as a representative sample of the sector as a whole or the GDC membership as a whole, but rather as a useful sample to understand how LMDs grow. Very quickly, here's a glimpse of the LMDs we interviewed and their rough location. Most of them are in sub-Saharan Africa, but we also picked LMDs operating in Asia and Latin America. The first message that out from our research is that LMDs have raised a significant amount of capital and are achieving substantial impact. So the 21 interviewees have reached a total of 2.6 million customers, of which 900,000 were in 2020 alone. So this translates to 42,000 new customers per company per year. The total sales revenue for the whole sample was $62 million in 2020, which is 3 million in annual sales revenue per LMD. And the 21 LMDs have raised a total of $108 million in different forms of capital, including equity, debt, and grants. And that translates to about $5 million of finance raised per LMD to date. Where is this capital coming from? I'll launch now a poll question for you. So of this $108 million that I mentioned before that these LMDs have been able to raise, what do you think is the main type of capital? Own capital, equity, debt, or grants? And please, when answering, remember that our sample is focused on the bigger last mile distributors, not the sector as a whole. And for your information, under own capital, I included also capital from friends and family, and under equity, we're also including convertible loans. So I will be stopping the poll now, since we've got enough answers. And I see that most of the answers have been debt. 41% of you answered that debt is the most frequently raised capital. What we learned from our, survey is that LMDs have raised more equity than any other form of financing. So most of this equity, which is 44% of the $108 million, comes from early stage impact investors, including those that are sector specific, for instance, focused on energy, and then tech investors, high net worth individuals, etc. On the debt side, debt has primarily come from crowdfunded loans and specialized debt funds, and there's been almost no participation of local banks in the mix. And with regards to grants, most grants come from project-based grants, although we've seen an increasing amount of results-based financing in the mix. I should emphasize once more that this is not representative of the whole sector, but rather reflects the sample of bigger LMDs within the GDC membership. A lot of the GDC membership not represented here or younger companies that have not yet got to the stage where they're raising commercial finance. What is the typical growth and fundraising journey for an LMD? So what we did in our research is map the 2020 revenue of LMDs against the number of years that they have been in operation. And the average growth for the whole sample is an increase in annual revenue of $440,000 per year. And that's the dotted trend line that you see in the graph. But then the individual data points representing each LMD are quite scattered. And what we did was divide the sample between faster growth LMDs and slower growth LMDs based on where they stand relative to that average line. This categorization is interesting for many of the investors we spoke to who would like to understand and do more to support the smaller companies and especially local companies. Although not perfect, we've seen a correlation between the pace of growth of these companies and the expansion strategies that they have chosen. So on the faster growth side, 2/3 of the interviewees in this category have long-term ambitions of market leadership, rapid scale, and international expansion. And on the slower growth side, 2/3 of the interviewees pursue consolidation in existing markets and profitability before scaling up. Two caveats here. First, this classification is for the purpose of this analysis alone. As I said before, from the perspective of the sector as a whole, all of these LMDs are fast growth. And second, we're using revenue as the main indicator for growth and impact. But there are other metrics like the number of customers reached, the number of products sold that are equally important. And we have included some analysis on this in the detailed research piece that has been published and is available for download in the website. So now to give you an example of one of the interviewees in this faster growth category, I'm now going to invite William from Zonful to share the trajectory of his company, a local pay-as-you-go solar company in Zimbabwe. that is already the market leader there and is starting their international expansion. The graph that you see in front of you maps their annual revenue over time, and the lighter curves in the background are those of all the other LMDs in the sample. So William, over to you to walk us through the milestones of Zanful.
Thank you very much. Good morning to everybody. As already mentioned, I'm William Ponela, the CEO for Zonful Energy. We started our journey a bit in a very difficult way. Initially, before we raised any funding, you can actually see from the graph that our growth was really constrained. And then we happened to raise money in 2018, that is through EACF, which was a combination of both grant and non-interest bearing loan, which had sort of helped us to really scale up. Because we were in a very unique position, unlike other people, where we had a lot of customers who were on the waiting list. So what was actually lacking was the issue to do with money. And as you know, being the last mile distributor, most of the suppliers would require you to pay everything in advance. So the issue of the initial seed money, which we got from ACF, sort of catalyzed us into other funding, like EEP, which we raised later after we raised the ACF. And then we went on and raised equity through two equity investors. The first one came in as a convertible loan, and later on, it was converted into equity. This is from Persistent Energy Capital. And Energy Aggregator Venture is EAV just came in and put in equity as well. So in short, this is how we have managed to get to where we are. And now we are currently in the market to raise money over 5 million, so that we can probably reach up to 100,000 so systems in the field.
Thanks, William. Yeah, when we were having the interview, one of the things that I found most striking is that, well, by year 4 or by year 5, you had about 300,000 outstanding orders for solar home systems that you could not meet because of being so constrained in terms of availability of working capital, which is a story that I've heard from many of the last mile distributors in this category. One more question for you, William, since you have raised different types of capital, equity, loans from different facilities and grants, as you mentioned, what type of capital would you say has been hardest to raise, and why?
Basically, equity and debt finance has been very difficult to raise, especially if you are coming from this part of the world, Zimbabwe, because of issues to do with the political risk. But more importantly, most of the funders would need you to get to a certain threshold before they start looking at your portfolio. So basically what happened, by us getting the initial seed money from ACF, this had also helped us to probably reach most of the threshold, which most of the funders would look at the moment.
Great. Okay, thanks a lot for that. Then I'll now proceed with the research and explain what we have done. So what we did is we aggregated the growth and fundraising data from Zonful, what William just explained and what we saw, with all the other LMDs in that faster growth category, to see what growth and fundraising look like for faster growth LMDs in general. And we divided their growth journey into phases, from proof of concept to accelerated growth, to understand what happens in each of these phases, how LMDs go from negligible revenues in the beginning, operate at about $1 million of revenue when they set up operations, and start growing exponentially after 4 years, with annual revenues increasing by 3 to 5 times from one phase to the next. We also looked into the role of that capital plays in each phase, from pre-seed to a Series A or Series B, how much they have raised at each stage and from whom. Unfortunately, we will not be able to cover this in detail now, but this information is already available with even more detail in the publication that you can download from the GDC's website, and we're happy to send you the link. But probably what's important to retain here as key messages is that faster growth LMDs have funded growth primarily with equity at all stages, from startup to expansion, which is represented by the red areas in the capital stack in the graphs. Also that they have experienced challenges in raising working capital loans and have had to use equity sometimes to finance inventory and operations. And that raising equity is becoming increasingly difficult for LMDs as they grow. VC investors look for very fast growth and they're not seeing profitability with scaling their existing investments in LMDs. Now, switching to slower growth LMDs, we would like to illustrate this by inviting Rocío from Bidhaa Sasa to walk us through her growth and fundraising journey.
Yep.
So over to you, Rocío.
Hi. Nice. It's nice to be here and sharing our journey with a wider audience, which is rare, as we always working in isolation. We have no clue what the world is about. Okay, so our journey. First thing I need to disclose is that we have not raised equity as opposed to many other players in the market. Therefore, my experience is all about raising loans, debt, because we sell on credit. Therefore, we need to raise the debt, and to a certain extent, grants and subsidies. And obviously, there could be some cause and effect on why we did not raise equity in terms of this profile. This is slow growth versus fast growth, but I won't go into that because you don't know what is causing what. Anyway, so for the first 2-3 years, as is shown here in this slide, we really didn't do much. And the reason why we didn't do much is because we didn't know what we're doing, right? It takes a while to set up a new business model, and it takes a while to find product market fit. So the fact that the revenues and the fundraising were very modest is because we were learning and we were trying to do things slowly, finding what is the right business model in these cases in rural Kenya. And only when you are confident that you have found product market fit, it does make sense to go out there and say, hey, would you like to invest in us? And we need this type of capital here, and there. So that was the initial part of our journey. Then you end up in this chicken and egg problem. As we all need debt to finance inventory, the investors obviously need to have track record, some evidence that your clients are paying back, and then you can meet your cash flows. And this is really a problem, right? The chicken and egg problem. You don't have enough traction, you don't have enough revenues, you don't have enough support and evidence that you can pay back the loan, So it really took us a while, I would say probably 4 years of operations to convince a proper investor to lend us money significantly, right? A large amount of money. And in the meantime, it was all about bootstrapping, equity from founders, very small loans from angels, and to a certain extent, grants and subsidies, especially the RBFs. I think for us, the RBFs have played a big role for us in our fundraising strategy. And then once you are able to prove that you can borrow and then you can repay, things get a bit better because there is some track record. There is you haven't defaulted. Oh well, let me talk to you, and then things get a little bit better. But we still haven't been really modest in our growth, as you can see there. We still are in Kenya. We are running a very, very small pilot in Uganda. We are very cautious about international expansion. And this is going back to our philosophy of first understanding what we are doing, trying to find product market fit before we even think of international expansion. And that's why our path, it looks quite different from others. And I think that's pretty much, the story so far.
Yeah, thanks a lot, Rocío. And then one quick question. So after you spent those first few years refining your business model and you were looking for capital to grow, would you be able to now summarize for us what you think were the main challenges to getting that debt financing that you needed once you were ready to expand?
Yeah, as we concentrate on raising this debt because of the inventory and the cash flow and everything else. So I will talk about the debt rather than equity. Equity, we don't have much experience. Also, on the debt side, for us, one of the biggest challenges that we have is that I would say 90% of investors are coming from a technology angle. They invest technologies, they don't invest businesses, in my view. We are a business, we are not technology provider. We are last mile distribution company. We are pretty much product agnostic, as we have a catalog or a range of products that we sell, and all of them, we sell them with payment plans. All of them need the finance. And which means that for me, I need to talk to, I need to go sector by sector, the agricultural sector, the energy sector, the water sector, blah, 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 talking to all these different players because they're all coming from a sector / technology angle. It makes my life really complicated. And then you need to negotiate potential conflict of interest because maybe this person doesn't want to have exposure to water, this other one has too much exposure on ag, and so forth. And it's not obvious, right? And I think I would naively, when we started and we decided to set up a product agnostic last mile distribution company, we thought that the diversification that we are giving or presenting, because we are doing precisely multiple products, will be a positive from an investor's point of view, but is rare. Most people don't think about diversification, and they think about investing in a particular technology, be it solar or whatever. That's been a challenge for us.
Okay, great. Thanks for that. So now we'll move on to what growth and fundraising for slower growth looks like in general. So we did the same aggregation exercise as we did before with the faster growth category. And in the case of the slower growth, revenues are lower than for faster growth companies, but exponential nevertheless, as you can see in the graph. The revenues in the growth phase increased by a factor of 3 in relation to the stage before, and then a 5 times increase during the accelerated growth phase. With regards to the growth of capital, most slower growth LMDs have funded company development with grants in yellow and with debt in blue, albeit substantially lower amounts than in the case of faster growth LMDs. Little equity has been raised by companies in this category, and what was raised was primarily from individuals, that is family, friends, and angel investors. Some companies might have wanted to raise equity and grow faster and were unable to do so, but many LMDs in this category made a deliberate choice not to raise equity for a variety of reasons, which include the growth and return expectations of VC investors and the cost and complexity of the whole process. Slower growth LMDs are achieving accelerated growth despite that lack of equity, albeit starting from a lower base and taking slightly longer to do that. So what is the relationship between capital raised and rate of growth? This is one other question that we tried to answer during our research. And for this purpose, we calculated the ratio between the total sales revenue of all the companies we interviewed and the total capital that they have raised, including all types, grants, debt, equity. And we used this as a very rough metric of the efficiency of LMDs in translating investment into sales and impact. A second poll question now, quickly. So according to this formula, what type of LMD do you think has realized higher revenues per dollar of capital raised? Faster growth or slower growth LMDs? We could rephrase this question as which type of LMD is leaner according to this imperfect definition of efficiency. So I'll give you a few seconds to answer that and remind you that this ratio is the total sales revenue from starting operations until today for all the companies in each category, and it's over the total capital that they have raised and borrowed since the beginning. But a caveat is that we excluded funds that were raised only within last year, because we assume that whatever they raised within last year has not yet translated into increased sales, so it would not be fair to include that. Okay, I'm seeing that people, I'll end the poll now and share results. I'm seeing that people have indicated 60% for slower growth LMDs and 40% for faster growth LMDs. What we've seen, so the actual results from our sample is that the ratio works out to $1.8 of revenue per dollar of capital raised for the faster growth LMDs and 2.4 for the slower LMDs. So yeah, that means that it is the slower growth LMDs that have realized higher revenues per dollar of capital raised. The details of our calculation are there on the screen for you to see. So the 9 faster growth companies we had in the sample generated a total revenue of $102 million and raised, and raised a total of $57 million in all forms of capital, excluding funds raised within last year. The ratio works out to 1.8. And the 12 slower growth LMDs that we interviewed generated a total revenue of $51 million and raised a total of 22 million. The ratio works out to 2.4. So in other words, faster growth LMDs sold twice as much, but then have needed to raise 3 times more capital. What is this telling us? Sorry. It is possible that the results of investments in faster growth LMDs may take longer to be seen and that they are yet to achieve economies of scale, but this trend is also suggesting that slower growth LMDs are leaner. This would be a very interesting finding for the sector, considering that most of the GDC members are slower growth companies. We did the same exercise to compare local and foreign-owned LMDs. We defined local as majority local ownership plus local leadership, so locally owned and led. And this is what we got. So for the 11 foreign LMDs in the sample, we had a total revenue of 91 million, and they had raised 63 million in all forms of capital, excluding what was raised just within last year. So a ratio of 1.5. And for the 10 local LMDs in the sample, the total revenue was 63 million and the total capital raised 16 million, a ratio of 3.9. So in other words, foreign LMDs have sold 40% more than local LMDs, but have needed to raise 4 times more capital, which suggests that local LMDs are probably much leaner than international ones. One investor we talked to through this process said that local companies typically have good financials because they tend not to have an equity cushion and therefore need to operate profitably since the start. While this is not backed by the data, we could assume that this is the result of unbundling and the specialization of the smaller companies, of local knowledge and overhead. And we think that perhaps for a portion of the market, especially the harder to reach areas, smaller and local LMDs will be a more efficient way to reach people in the long term. What challenges do LMDs have when it comes to raising capital? Even the most successful LMDs have difficulties in raising capital that they need to grow. And from the interviews we did, the most frequently mentioned challenges were related to equity first. And first, especially for the small and local LMDs, it is too costly and effort intensive to be investor ready. The companies do not have the resources to go through that process. And second, and especially for the faster growth LMDs, it is increasingly difficult to find equity with realistic growth and return expectations for LMDs. The limited number of investors in the space have already placed their bets and are not necessarily seeing profitability with scale. Then in relation to debt, access to working capital loans are the most frequently mentioned challenge overall, which it makes sense for distributors. And the top 3 issues in this category are: first, that a substantial track record and turnover are needed before being eligible for loans. The smaller capital loans for early stage LMDs are not readily available. Then for the larger LMDs, the debt amount is very much constrained by the equity that's available. And this problem is compounded by the difficulty of raising equity in the first place. So it's getting harder and harder for LMDs to access these bigger facilities that provide working capital with the continuity that they need. And then on a general category relating to all sorts of capital, including grants, we could cite high administrative burden. These are heavy due diligence processes and negotiations that take too long, which usually lead to delays in dispersing money that cause a lot of stress for last mile distributors. So to summarize, we have seen that fundraising challenges at the early stage are similar for all the LMDs we interviewed, faster and slower growth, and then vary depending on the growth trajectory. So during the proof of concept and establishing operations, companies need early stage capital to invest in minimal viable infrastructure, so warehouse, transport, HR, etc., as well as a bit of working capital for inventory and consumer financing. The main barriers at this stage are startup capital, especially for the local LMDs, and the smaller working capital loans. For LMDs following the faster growth trajectory, who are typically focused on quick geographic expansion, these guys in theory need a balanced mix of equity to invest in infrastructure and working capital to finance inventory and receivables. But in reality, we're seeing it is increasingly difficult to find equity investors. The companies have had to raise more equity than they would like, including to finance inventory, and growth is constrained by the availability of working capital financing. For the LMDs in the slower growth trajectory, who are typically focused on sustainability before scaling up, in theory, companies need mostly working capital. In reality, access to loans is capped by their balance sheet. So to overcome these challenges, the key forms of finance that we need in the sector are startup capital and the support that LMDs need to raise it, access to equity for the faster growth LMDs to continue to scale, and easier access to working capital across the board with reduced collateral requirements, better terms, and rates. And final conclusions of this piece before I hand over to Lucy is, first, LMDs have raised a significant amount of capital and are achieving substantial impact. On average, each LMD has raised over $5 million and is reaching 42,000 new customers a year. Second, faster growth and international LMDs have raised more capital, in particular equity. They tend to focus on rapid expansion, including international replication. Third, the slower growth and local LMDs achieve more sales per dollar of capital raised. They tend to focus on achieving profitability first and then expand. And successful LMDs have shown that they need between $100,000 and $400,000 of startup capital in their first 2 to 3 years of operations to get started. This applies to both faster and slower growth companies. Then they need rapid, continuous, and growing access to working capital debt from $100K to a few $1,000,000, depending on where they are in their journey, to leverage the infrastructure they have built and increase sales, and equity to expand rapidly or as a way to access more debt. And finally, even those successful LMDs are still facing barriers to access capital, including the most cited reasons of needing a long track record to be eligible for loans, loan amounts being contingent on the amount of equity, and difficulty to access the larger working capital facilities, the difficulty and high cost of being investor ready, and finding growth equity. So with this, I finish my part of the presentation and now hand over to Lucy to provide insights that resulted from the investor forum in April. Thank you very much, and over to you, Lucy.
Thank you, Fede. So we've heard a lot about the last mile distributors' perspective on fundraising. This next part is really on what investors' thoughts are around those needs. And as you can imagine, it's not that investors are not interested. The sheer number of people who attended the last mile distribution forum, investor forum, we had over 90 participants, shows that actually there is really an eagerness from donor and funders to look into this space and act. So why do we see all these barriers? So if we move on to the next slide, the first thing to realize is that actually one of the key issue is that the challenges that LMDs themselves face on their markets are actually similar to the ones that investors face, in the sense that given the challenging markets that LMDs operate in, the risk-return ratio is basically not looking that attractive in the first at first glance. So to illustrate that, basically it's a question of high risk, high cost to serve, and limited returns. On the high risk category, LMDs themselves obviously face the risk that their clients are often people who are unbanked, who don't have a lot of documentation. So they have limited information on these clients. And in addition, these clients have fluctuating capacity to repay, which means it's quite difficult to assess for example, market size. On the investor side, it's a similar issue of lack of information about the sector. I mean, the GDC has been in operation for about 2 years now, but before then, I don't even think the term last mile distributor was very well understood. And there is very little information or benchmark around what is a normal good performance in this sector. And in addition to this, on both sides, there's the obvious risk of investing in low-income country and the currency risk that adds up to that. There is also an issue of high cost to serve for LMDs themselves, given that you need to go and serve distinct pockets of clients, each relatively far away. There are always high cost to serve, compounded by the, not just distribution costs, but also the marketing costs of promoting products that often weren't there before last mile distributors go into these regions. Similarly, that's echoed on the investor side, where they see a small and fragmented LMD market. I mean, as a reminder, the 21 LMDs that we interviewed for these studies are actually really the kind of top 10% of the biggest LMDs that the GDC is representing. And each of them has limited financial capabilities, not necessarily very structured financials, especially at the beginning, which makes them each quite costly to assess. And finally, and apologies for the phone ringing, these markets typically shows quite limited returns. So on the LMD side, because they're by definition serving low-income clients, there's limited sales opportunities per client. On the investor side, potentially limited market opportunity per last mile distributor. And for both, there's the issue that typically last mile distributors and their sales agents might have limited marketing and sales capabilities, given the kind of HR, the scarcity of talent that many low-income markets experience. So why is this, or rather, how does this relate to what we heard before? Actually, these three issues of high risk, high cost to serve, and limited returns explain a lot, from the investor perspective, explain a lot of the barriers we've seen or the challenges we've seen mentioned by the last mile distributors we interviewed. And if we move on to the next slide, which starts back from the key challenges mentioned by LMDs, which are the ones Federico mentioned earlier on the right, investors, when they see that list, they say, yes, it's true. We ask for a lot of track record. If I start with the first challenge at top there, we do ask for a lot of equity to be able to give debt. We do ask a lot of documents for that investment readiness, and we do complex due diligence. But that's because we don't know this market. We see it at high risk. It's the only way we can feel we've lowered the risk enough to invest. Similarly, the challenges of finding equity investors or finding large working capital facilities, there are not many investors or large working capital facilities in this space because of this compounding issues of high risk, high cost to serve and limited returns. So investors, are not sure they should set up a new fund specifically focused on this at this stage. The currency risk and convertibility speaks of itself. And the last point that a lot of last mile distributors are making around the fact that the interest rates are too expensive. When investors hear that, they're saying, but how else are we ever going to make money in these markets given all the risks above? And this is our business, to find a way to invest in investable businesses. So there's really a kind of mirroring of issues on both sides. This is a little bit the kind of bad news. There's a lot of problems. Now, the good news is there's also a lot of emerging solutions that we've heard about in the consultation we did with funders and also during the investor forum that took place a bit over a month ago. So if we move to the next slide, we've tried to show a few of these emerging solutions, basically trying to answer the three buckets we had before of, at the top, lowering the perceived risk of these investments, on the bottom right, lowering the cost to serve, and on the bottom left, improving the returns of these investments. So a few examples of solutions that lower the perceived risk. Some funders or donors have moved in early grant funding with very little conditions, like Deep Rise, for example, that provides small grants to test new innovation at the last mile. There's new financing and fundraising TA. That was actually one of the questions that one of you asked in the chat around how can we get what investors want. So a good news is there is an increasing number of accelerators and TA around technical assistance around raising funds that is available, including in Southern Africa, which I think was the question in the chat. As the GDC, we're also trying to provide as much information about the sector like we're doing now as possible to help reduce that risk perception. And finally, there are some innovative financing instruments that also come to counter that risk, like the guarantees that Crowdpower has set up. If we look at the bucket of improving returns on the left, impact-based incentives are basically also a new way that allow to improve returns for investors. There's a couple of funds. So the Roots of Impact iGravity Fund is already running with that principle of basically paying per impact created, per unit of impact created, in addition to the natural impact that last mile distributors would have, which basically enables investors to then get more money if their investment is more impactful. And Acumen is also working on setting up debt funds with lower interest rate, depending on the impact that last mile distributors would generate. In the middle, between that improving return and lower perceived risk, we've put capacity building, training on sales, training on improving the capacity of the management of last mile distribution companies, which can both help lower the risk and also increase the sales and hence improve the returns of last mile distributors. And to name a few, Venture Builder and Persistent, as well, who are also investors, have set up technical assistance program and capacity building programs that are very emerging and so far very appreciated by last mile distributors. And the Mille Center is also providing very interesting TA to last mile distributors. On the side of lower cost to serve, we've seen some innovation in aggregation of transactions to lower the cost of serving individual small last mile distribution, notably a new scheme being set up by VIA, and collaboration with local funders as a way to avoid the potential international costs of funders that actually Africa has started doing. And finally, in the middle, both lowering perceived risk and cost to serve, we've seen innovation around collateralizing accounts receivable. And we've also seen innovation around new data sources for due diligence that really leverage technology, in particular in the pay-go area. For example, with CIMA funds working with Angaza to get a first idea of the history, the payment history of the target investees they're looking at. With this, what remains to be done and what is not more happening, not happening? We've asked that question at the end of the investor forum. And interestingly, the issue that funders brought forward was not so much that they needed support to create a new fund, but rather that they were looking for more coordination, more information exchange, because right now, each of these funders with innovative scheme is kind of not reinventing the wheel, but maybe replicating the wheel by redoing the due diligence on the same companies, which results in the delays that last mile distributors have mentioned between 2 rounds of funding. And if you remember the growth trajectory of Zonful, for example, in spite of all their success, they had to take a dip in sales at one point because they were waiting for that next round of funding to be available. And this is really something we've seen many times. So coordination of funding is at least as important as more funding in this space. The next 2 requests that donors and investors had were around more information, either benchmarking tools to assess last mile distributors' performance, or more generic information, data and insights about the LMD sector. So taking these recommendations into account, and as Charlotte mentioned at the beginning, thanks to Get Invest support, this is what, as the GDC, we are going to be doing in this space over the next 6 months. If you can move on to the next slide, Fede. Thank you. So we will try to do our best and to answer these requests and make sure that funders have more opportunities to invest in LMDs and that LMDs get hence more rapid and adequate access to funding. So the first thing we will be working on is facilitating more dedicated spaces for LMDs, funders, and technical assistance providers to work together and to cooperate, network, exchange information, hopefully including making these due diligence processes potentially collective to avoid, reinventing the wheel and putting too much burden on the LMDs. We will also be looking at creating a clearer picture of the capital continuum. So what are the current funds available at which level of growth for last mile distributors. And finally, we're going to be developing an investment readiness tool to help last mile distributors understand better the due diligence process. I think there was also a question on this in the chat earlier on. This is, it's great that we're able to do that thanks to Get Invest. We really see this as the beginning. There's much more that could be done, in particular around that first idea of coordination across funders, where there are two ideas that came out of the investor forum were around actually creating a more structured continuum of funding available for last mile distributors, either with a structured alliance of funders or with some sort of fund of funds that would kind of bring together all these great innovations that we've mentioned a few of in terms of the continuum of funding. We would also want to be looking at creating more storytelling to showcase better GDC's members' fundraising journey, and also showcase those that haven't necessarily raised fund yet and make them more visible to the sector. And finally, we're also thinking about creating that benchmarking tools that investors have asked for, and actually also last mile distributors have asked for, to know themselves where they can improve and become more attractive for investor and more generally reach more people with more efficient processes. These are all yet tentative ideas. Nothing is set in stone. We are actually, as the GDC, preparing our strategy for the next 3 to 5 years, this end of year. So if you have any suggestion, any thoughts on whether these are good ideas or horrible ideas that will do nothing, or if you have other ideas of things we should do, please don't hesitate to type them in the chat. We'd really welcome your feedback. So I think that's it on my end. I'll now hand back to Charlotte for the question and answers.
Thanks, Lucy. Thanks all speakers. I think we've actually done a very good job of answering the questions that have come through in the chat. So I might, given we've got a couple of minutes left, I'll just open up the floor to our speakers in case you'd like to elaborate on anything that you mentioned earlier, or Lucy, if you want to pick up on anything that came through in the chat, for example, around investment readiness. Yeah, so over to you, and otherwise we can move forwards and wrap up.
I have one clarification to make regarding a question from Laura Sundblad regarding the split between cash sales and pay-as-you-go sales in our sample. Just to clarify, so most of the companies we interviewed, 80% actually of the companies we interviewed are providing consumer financing, and they're evenly split between slower growth companies and faster growth companies. So we would not consider that that the sample is heavily geared toward pay-as-you-go companies in the faster growth categories and cash sales in slower growth. It's rather equally spread.
Maybe another question that would be, that was in the chat, I think came a bit from two different people, is what are the key criteria that investors look for? And maybe Rocio or William, if you want to give a bit more of your own experience on this, that would be helpful.
I can go, just give some time to William to reappear. Key criteria, yes, a really good question. The truth is that they are not two investors will ask you the same question. So every time you have to start the conversation from scratch because they all come from different flavors and they have different interests. So it's more a reactive conversation than a proactive one. They will say, these are my criteria. Do you comply with it? Yes. Can you prove it? Yes. And not two of them will have the same criteria. So that's the truth, right? You can do all the preparation in the world you want to have all your data rooms and all the Dropboxes folders ready to go, but in reality, they all want to see slightly different type of data and slightly different ways of presenting your story. But in general, I think from a debt point of view, it's obvious that they want to be sure, or they want some security or some comfort that you will be able to repay. So it's really about understanding your cash flow. You really need to understand what did happen in the past. As we are all selling on credit here, do people repay and have all the metrics needed? I do recommend that you look at the microfinance world and you use standard banking metrics to have those conversations with the lenders. Because what is a repayment rate? There will be 5 different definitions. So I think adopting some standards when you are doing finance helps the conversation massively, because then you are speaking the right language. If you can prove that your cash flow model is sustainable, realistic, and so on, then there shouldn't be any reason why they should not lend to you, right? And I think it's all about cash flows.
Okay, William, feel free to jump in. Otherwise, we've got time, I think, for another question. So an interesting one around crowdfunding. Oh, William?
Okay. Yeah, sorry, my network would not allow me to continue, but I think you're hearing me clearly. The other thing to add on what the investors need, this is a suggestion which I give to other people, is to say they just have to create a data room, which they have to regularly share with the potential or the existing investors in regards to the activities and the different milestones the companies achieve. Just to be in touch, I think the issue of communication matters more, especially if you've got intentions to raise the same amount of money from either potential or existing shareholders. And then just jumping on the other question to do with whether our business models fit crowdfunding. Yeah, of course they do. And it's one option which we are also currently looking at. Although the process tends to take some bit of time, we have successfully managed to raise money through crowdfunding from Kiva International. And just because of our portfolio, we actually managed to raise money in a record of 24 hours. We actually raised what we had intended to raise. And we intend to look for a potential partner to go the same route again.
Thanks, William. That pretty much brings us to time, actually. So we've just got a minute left. So let's move to a wrap up. I know there were a couple of questions left in the chat, but we'll make sure that we follow up with you. Okay, so yeah, as always, we'd really love to hear how you found the session today. So please let us know how useful or unuseful it was. We'd also like to just flag, as Lucy mentioned already, that we have a couple of activities coming up, including our strategy for 2022 to 25 in the next few months, as well as our next webinar, which is being delivered in partnership with Value for Women, looking at gender inclusivity and last mile distribution. So please keep your eyes peeled for that in our newsletter and join us if you'd like to. And just to say another big thank you for joining us today. As always, it's been great to conduct this discussion. We really hope that you've enjoyed the presentation, encourage you to dig into the research for yourselves. And as always, get in touch with us if you'd like to discuss anything further. So thank you very much.
Thank you.
Thanks. Cheers, goodbye.